And so here's kind of the big final example is, and we'll walk through this together. Let me do a cost of comparative statement for inventory. So we can see how an error would impact us for a year. So they're saying 2015, 2016, 2017. Correct amounts, sales, cost of goods sold, inventory. Cost of purchases, goods available for sale. I want you to see how these numbers play out. Ending. You're going to need to be able to calculate all of this. Inventory, cost of goods sold. If we were in physical class, I'd ask you to go to try to calculate this yourself. And I'd go around the class asking you to do it so you can see. I could see if you're on the right track. And so this is the correct amounts, and then we'd also have error. So we're saying sales of 10,000 in each year, right? 10,000, boom. I want you to see how an error can impact all of these years. It purchased inventory of 7,000. This is where I'm getting all this information. I'll give everything dollars. 7,000, 7,000 for each year. And the beginning is 2,000. From the beginning and end of 2,000. So our ending inventory is also always 2,000. Keeping it simple. In accounting for inventory, it made an error at the end of 2015 that caused a year-end 2015 inventory to appear in its statement as 1,600 rather than 2,000. So we'll see the error down there. So let's calculate the correct amounts first. So goods available for sale. It's always going to, our goods available for sale is always our beginning inventory plus cost of purchases, right? Know that answer. And then our cost of goods sold is going to be our goods available for sale less our ending inventory. And then what is our gross profit? Our gross profit is our sales minus our cost of goods sold. That's how all these numbers are being calculated. I'm just putting in bold when there's math done. And I can copy all of this over for down below. We can see what happens. What if I made an error? So someone did an inventory count wrong in year one. Our gross profit is 2,600. Now we can see that this flows through. My beginning inventory is always going to be equal to my ending inventory. And so now my gross profit's wrong for year two, right? For 2016. And then 2017, it all become fine. My beginning inventory is on. So 2 years later, everything's fine. But if I make a mistake in year one, it flows through, and I now am incorrectly calculating cost of goods sold and gross profit for not only year one, but also for year two. Not only 2015, but also 2016. This is where we have to be very careful in our inventory accounting, right? Does this make sense? Cool. So now we're going to talk about some ratios. So something we can do to assess a business can be profitable in two ways, really. You can have a successful business in two ways. You could either sell very high margin goods, but not frequently. You could think of a car dealership, right? You're probably not going to sell a million cars a month. You might sell 100, but hopefully every car gets you $10,000 or something significant. Or You can sell very low margin goods extremely frequently. So you're not going to make $1 million or $10,000 off of every time you sell Top Ramen. They might make 10 cents, but they want to sell that. They want to sell 1 million units of Top Ramen every single month. Right. So you can either sell cheap goods very frequently or very expensive goods infrequently. And so one of our ways we can assess this, how quickly inventory turns over or how quickly someone sells inventory, a business sells inventory, is by their cost of goods sold by the average inventory amount. So you and I can look at any business. We could look at a Starbucks and determine how quickly they turn over their inventory. And so we'll do that together. But we can also look at how quickly they turn it over in an amount of months just by looking at their financial statements.